Assalamualaikum warahmatullahi wabarakatuh. Let me introduce myself. My name is Vena Ameliya, NPM 234120039, Accounting Class 23A, Intermediate Financial Accounting Course. Okay, here I will explain about merchandise inventory method. Let's discuss it together. The merchandise inventory method is a method used by companies to record and calculate the amount and value of the merchandise inventory they own. This method is very important because it affects the value of company assets in the financial statements, as well as the calculation of the cost of goods sold. Types of inventory methods. 1. Periodic method, periodic inventory system. Recording, carried out periodically, usually at the end of the accounting period. How it works: the amount of physical inventory is counted physically at the end of the period. The difference between beginning inventory and ending inventory, plus purchases, minus sales, will produce the cost of goods sold. Advantages: simpler and lower recording costs. Disadvantages: information regarding inventory is not always up to date. 2. Perpetual method, perpetual inventory system. Recording, carried out continuously every time a purchase or sale transaction occurs. How it works: every purchase or sales transaction is immediately recorded on the inventory card, so that the inventory balance is always updated. Advantages: inventory information is always accurate and up to date. Makes it easier to control inventory. Disadvantages: requires a more complex recording system and higher recording costs. Inventory valuation methods. FIFO, first in, first out. The goods that are first in are considered the first to go out. LIFO, last in, first out. The last item in is considered the first to go out. Average, the cost of inventory is calculated based on the weighted average of all purchases during the period. Special identification, each unit of goods has a different cost price and is specifically identified. Question. This is the question, let's answer it together. Answer. To determine the ending inventory value and COGS for each sales transaction, we need to know the inventory valuation method used, for example FIFO, first in first out, LIFO, last in first out, or the weighted average method. 1. Beginning balance, November 1st. At the beginning of November, the company had an initial inventory of 100 units with a price per unit of IDR 1,500,000. 2. Purchase, November 3rd. The company purchased 50 units at a price of IDR 1,600,000 per unit. Total inventory after this transaction will increase to 150 units. 3. Sales, November 6th. The company sold 80 units at a selling price of IDR 2,200,000 per unit. To calculate COGS for this transaction, we need to take 80 inventory units from existing stock according to the selected valuation method. 4. Buyback, November 10th. The company returned 10 units purchased on November 3rd. With this return, the amount of inventory from the November 3rd purchase will be reduced. 5. Purchase, November 15th. The company purchased another 40 units at a price per unit of IDR 1,700,000. The company's inventory will increase. 6. Sales, November 20th. The company sold 60 units with a selling price of IDR 2,300,000 per unit. To calculate COGS for these sales, we will use existing inventory according to the valuation method. 7. Resale, November 25th. The company received returns of 10 units from sales on November 20th, so inventory will increase again. 8. Purchase, November 28th. The company purchased another 30 units at a price per unit of IDR 1,750,000. 9. Sales, November 30th. The company sold 70 units at a selling price of IDR 2,350,000 per unit. COGS for these sales will also be calculated according to the valuation method used. Okay, that's all I can explain regarding bank reconciliation. I'll end it. Wassalamualaikum warahmatullahi wabarakatuh.